Welcome everyone to today's nonprofit education series. My name is Daniel Figueredo. I'm the co-leader of BPM's nonprofit practice, and it's a pleasure to have you with us. We're going to start off with tax, so let me introduce my nonprofit tax leader, Tammy McInerney. She is leading up BPM's nonprofit tax group and also focuses extensively with high net worth individuals and their family foundations and trusts. And then we also have Elena Serebrakova, another one of our nonprofit tax leaders, focused exclusively on nonprofits. They're going to kick off today's webinar with discussion on tax updates. And then it's my pleasure to also have Shannon Winter, my esteemed co-leader of the nonprofit industry group at BPM. She focuses on all sorts of nonprofit organizations, leads up BPM's membership with the Government Audit Quality Center, serves many social service organizations, foundations, religious organizations.
So we're going to go over some general updates. We're going to cover the employee retention credit, and actually our business advisory team did a full webinar on the employee retention credit because it is a pretty complicated credit. We'll go over just a few updates related to 990TE and excess compensation and some state reminders. So one thing that's new this year is there is a mandate for electronic filing. And so for 2020, we now have to e-file all 990Ts. So anything with the due date on or after April 15th must be electronically filed. You cannot file those on paper. There's a limited exception for certain 990Ts if they were postmarked before March 15th, but at this point, everybody should be electronically filing their 990s. Same thing for 990PFs, and this is the one that's a little bit more challenging because a lot of nonprofits were filing their 990s electronically. 990PFs tend to have more data related to them and attachments, so that's also a mandate for 2020 filings. All 990PFs have to file electronically beginning this tax year. So I wanted to give you a little overview on the employee retention credit. This one, like I said, there's a lot of nuances with this, and there's some interplay between the PPP loan forgiveness. So there is a full webinar that our team did for this back in June, but I wanted to give you an overall so that you know how valuable this credit can be. So this credit was originally enacted with the CARES Act, March 27, 2020, and the intent was to give an incentive to businesses affected by COVID-19 to keep their employees on payroll. And so it was particularly for small businesses that were suffering, and it includes exempt organizations because a lot of them also, were greatly affected by the pandemic. So it's a payroll tax credit reported on your payroll return, and many of you may have already taken this. And it is a fully refundable credit. So if your total retention credit exceeds your payroll tax liability, the excess can be refunded to you rather than carried over to subsequent quarters. The initial guidance that came out was that you could not receive a PPP loan and also take advantage of the ERC. And so a lot of organizations and businesses were not initially taking this credit. So, so like I said, that restriction that was in the initial law was retroactively removed. So now employers can claim the employee retention credit even if they received a forgiven PPP loan. So you can't use the same expenses for the credit, but you can, if you had excess expenses over what you had for your PPP, you can use those expenses for this credit. And then they enhanced the credit. So some of the enhanced benefits for 2021, they expanded the credit so that it's now available on wages up to $10,000 per employee per quarter. So prior in 2020, it was $10,000 per employee for the entire year. And it also expanded it to allow the credit on up to 70% of wages as a credit. It was previously 50. So the credit maximum per employee is $7,000 for each quarter in 2021, so it's a lot more than it was in 2020. And they also raised the full-time employee threshold to 500 employees. So this was previously only 100 employees. So it was really only small employers that were eligible for the credit, and now it's expanded so a lot more employees or employers can take advantage of it. And one other significant change that they made was if your organization had a significant decrease in receipts, it was previously limited to organizations that had over 50% decrease in receipts, and the expansion changed that to 20%. So it's available to a lot more people. Yeah, so here's a little chart that compares what the original law was under the CARES Act and what it is now under the Consolidated Appropriations Act. So, you know, like I said, 50% was under the previous law, it's now 70. So the max was a $5,000 credit per employee under previous law, and now it's $28,000, up to $28,000 per employee. So that's a significant difference. Under the previous law, if you received a PPP, you couldn't take this credit. Now you can, but you can't use the same expenses. The size of the employer limitation has changed, and now a lot more organizations qualify under the gross receipts tax. So, and it's available for 2020 and 2021. Next slide. So here is just an example to show you how much more valuable the credit is. So under the previous law, the maximum credit you could take in this example, which is, this is an employer that qualified under the credit. They had 10 employees and they were all had enough wages to maximize the credit. So under the previous law, this employer would get a $50,000 credit. And under the new law, they would be eligible for much more credit. They could get up to $280,000 in this example. So it's really something, if you hadn't looked at it before, it is a payroll tax credit. So, I'm an income tax person. It's not something that, Lane and I are doing because it's a payroll tax credit, but it is a very valuable credit for your organization if you qualify. So here's a comparison of the eligibility requirements. So in 2020, an employer who experienced a 50% reduction in gross receipts compared to the corresponding quarter in 2019 would qualify. So the credit it uses the payroll costs plus the employer's healthcare costs. So it's either it's a combination of that, and it's a proportionate share of your healthcare costs and wages. And another test is if your operations were fully or partially suspended due to the orders from a governmental authority, then you would qualify. And there's some nuances with that. So if you were partially shut down, if you're going into that because you're not qualifying under the gross receipts test, if you were partly shut down, the credits available for the period of time when you are shut down, and they go over these nuances in our full webinar that covers this, but there are some nuances on how these rules are applied. So for 2021, instead of having a 50% gross reduction, you only need 20, and that's compared to the corresponding 2019 quarter. Same test basically, it's just the 50% was reduced to 20. And again, you still have that if your operation was fully or partially suspended due to orders from a governmental authority. So in California, we did have a shutdown. And so most employers were affected in some way, but not all. So for gross receipts for nonprofit entities, this includes your basically your nonprofit activity, but it also includes your investment income. So interest, dividends, rents, royalties, and gifts and grants. So if you're a nonprofit entity and your grants have gone down because your organization just wasn't getting the support that it had in prior years, then you may qualify just based on that, and members' dues as well. Now that you can go back retroactively, people are claiming the credit on a 941X, and so if you use a payroll company, and you haven't taken this already, contact them and ask them what you need to do in order to take this credit. So here's some of the rules. I don't do payroll, so I don't have much experience in actually claiming the credit. A lot of employers were taking the advance credit on Form 7200, but at this point, most people are going back and filing amended returns, or claiming it on their current year payroll returns. Next slide. So one unusual thing that Congress threw in here was normally the statute of limitations that applies to tax returns and payroll returns is 3 years. So they have 3 years from the date that you file a return to come back and audit you. And since this is a very valuable credit, and there's always some bad players, people that take advantage of good things, they've extended the normal statute of limitations to 5 years on this credit, which is unusual. I've actually never seen that in my career that I can remember. But so that just means the IRS has a little bit more time to come back in. They're really busy dealing with a lot of other issues right now. So they did give them extra time to come back in and see what people are doing and what kind of expenses that they're using when they're taking this credit. So just be aware of that. Keep your records. Make sure you keep those on file for 5 years instead of 3. And there are a lot of nuances with this credit. There's a lot of frequently asked questions. So the IRS has their FAQs listed, and they go over a lot of those nuances, which are really about what qualifies for the credit and the interplay between the PPP loan forgiveness and your employee retention credit. And there's some strategies that you can take to really maximize the credit, because this one has different expenses that qualify. This is basically wages and healthcare, and your PPP loan has, you can use different types of expenses for the forgiveness. So it's important to keep that in mind when you're applying for your PPP loan forgiveness if you haven't done that already. And we do have a team of people that has been helping clients with this. So, if your organization needs help with this, reach out and we can connect you with them, because they really, they're great at looking at the nuances of this credit and making sure that you're maximizing this in combination with your PPP credit or PPP forgiveness. Next slide. Yeah, so there's a couple of new notices that came out this year to clarify how the credit works, and so that you can use excess payroll not needed for PPP forgiveness for the ERC. Payroll expenses listed on the application and needed for forgiveness are deemed to be elected out of the ERC. So that's why it's really important that you're aware of these rules when you're applying for your forgiveness if you also qualify for this credit, because you want to be able to maximize the credit as well. So the rules are very specific. So just if you're taking the credit and you need help, reach out and we can connect you with people that can really walk you through this. Oh, and it's also available for new businesses. So there's an IRS notice that came out that explains how a new business can take advantage of this credit as well. So you don't have to be an existing business in order to take advantage of the credit. And next slide. So this is a very simple example of how an organization who received PPP funds and qualifies for the credit can take advantage of both. So in this sample, they had $1 million of qualified wages, and 600,000 of those wages were paid from PPP funds. Then they had 400,000 left over that was available for the credit. This is a 2020 example. So in this case, they had available, wages left over to take the employee retention credit. And next slide. So as far as PPP loan forgiveness, there's been different approaches and different opinions on how you report your PPP on your 990. There hasn't been any specific guidance from the IRS, but in general, most people are reporting it as a government contribution because it is funds that are coming from the government. I think Shannon's going to go over the financial statement reporting or PPP loans. So generally on the tax side, we will follow the financial statement reporting, but it's not always the same. So we look into the facts and circumstances at each case. If it's forgiven, you may want to report it in the year the actual cash is received. If it's not forgiven, generally we keep it as a loan until it's actually forgiven. But it's a case by case.
Good morning, everybody. I will go briefly over final regulations which were issued for unrelated business income silos. And what it means that you kind of need to separate your unrelated business activity in different buckets. Before 2017, we grouped everything together. Now IRS came in December 2017 and said, okay, you cannot mix your different unrelated business activity. And if you have 3 different activities, you have 3 different buckets. If you have loss in one, income in 2 others, you can't mix it. Loss goes separately, you pay tax on income. That happened in December 2017. Then IRS issued a couple of guidances. First, they issued in August 21, 2018, talking about investment activities, how you look at your K1s, how you need to group this activity. Then there was a proposed regulation in April 24, 2020. And finally, 3 years later, almost, we got final regulations. In the final regulations, IRS addressed some of the questions which were submitted, some of the comments. They change the way how you're gonna group activity for investment activity a little bit, which actually good news. They said, okay, you need to use now 2-digit code to identify your unrelated business activity. Next slide, please. This is the codes, and they're not very descriptive. That was 6-digit code before. Now it's 2-digit codes, and you kind of need to go through and figure out what actually works for your unrelated business activity, not for the exempt activity. If you have educational institution, which is 61, which, I don't know, does something, sells T-shirts, which is unrelated business activity, you cannot use 61. You need to figure out what code to use for unrelated business activity. And once you pick the code, you kind of stuck to it, you can change it, but when you change it, you have to submit explanation on an entity. Next slide, please. There is no need to use the codes for controlled entities. So if a nonprofit has controlled entity, you treat a controlled entity as each separate trade of business. If you have one control entity and you have payments from the control entity, which unrelated business income, that's your one trade of business. You have 3 control entities, you have 3 separate trade of businesses. If you have S corporation interest, each S corporation interest is treated as a separate income stream, except when you can group them together. Next slide, please. Next slide. IRS came and said, okay, we're going to look at investment activities. There were a lot of comments saying, we get the K1s, how do we figure out what to group together? And if you have 10 K1s, they all throw unrelated business income, and you own like 2% in each K1, doesn't make sense to have 10 separate buckets. So IRS said, okay, we agree. If you have a qualifying partnership interest, and its definition is going to be later, you can group them together. If you have qualifying S corporation interest, you can group them together. If you have debt finance property, which throws unrelated business income, you can group it with qualifying partnership interest. You can treat it as a single unrelated trade of business. You don't have to assign the code, and it's hard to assign the code because when you look on partnership, you don't really know what they're doing sometimes. And there is no straight code for investment activities, so kind of pick and choose. Next slide. Next slide, please. Shannon? Yeah. A qualifying partnership interest, now we can go back. So how do you determine what is a qualifying partnership interest? Qualifying partnership interest usually it's partnership interest where you have 2% of ownership or if you meet a participation test. And since if you designate it as a qualifying partnership interest, it will remain qualifying partnership interest unless something changes. For example, you had 2% of the partnership interest, and now you have 60. Something changed. Next slide. There is a participation test that says, okay, treat the partnership interest as qualifying partnership interest if exempt organization holds no more than 20% of the capital interest in a partnership, it does not significantly participate in the partnership. If exempt organization is a general partner, it doesn't apply. So if you have an exempt organization, which is a general partner, which is not usual, but it happens, you can't say, I own 1%, I'm a general partner. Yeah, I can try to speak a little louder. I saw the comment. You cannot say I have 1%, I'm a general partner, I'm going to treat it as a qualified partnership interest. Next slide, please. There is also the minimus rule, which says, okay, if you have no more than 2%, you can aggregate all those partnership interests together. So if you have 10 K1s, they all have unrelated business income. All the K1s have no more than 2%. You don't need to figure out how do I separate it. Just count it as one unrelated business income silo. Next one, please. Now we're going to think, how do we approach that? First, the organization should ask, okay, do I have a limited partnership interests? Even if I do, does this partnership ever generated unrelated business income? Is it generated it this year? If there is no unrelated business income, you don't need to worry about it. If there is unrelated business income, look at the ownership and profit and loss percentage. Less than 2%, group it together. More than 2%, but less than 20%, you need to figure out, does exempt organization participate in a partnership? And what does it mean if it participates in a partnership? It means that exempt organization can actually say to the partnership, you're not going to do something. The partnership says, okay, we're going to do this new activity. An exempt organization comes in and says, no, you can't do that because maybe it will blow its exemption. Maybe it's a private foundation and there would be some other problems. Or somebody sits on the board. It's more acts as a management capacity on that partnership. Next slide, please. The final regulation also said, okay, even if you have more than 20% in ownership, you can look through the activities and figure out if you have second tier, third tier, fourth tier partnerships, how much you actually own. So what's your ownership percentage? And it's really good in theory, but in reality, it's going to be really hard because when you get a K1 and your K1 says 50%, you go to partnership. If that partnership only invests in another partnership, it's easy. You ask, okay, what is your investment? You have 4% in another partnership. I have 2%. But if you have multiple tiers and information coming from different partnerships, it's probably impossible to determine. And you also need to separate the income streams. So I don't know how it's going to be in practice, but you have an option to go to the partnership and ask that question. There is also was change from related party interest when proposed guidance came out. At one point, there was guidance, you have to aggregate everything. If you have a disqualified person and you have ownership of, for example, private foundation has 2%, disqualified person has 20%, then you have to kind of aggregate. Now you need to look, there are specific rules, what you aggregate and what you don't. Also, Schedule K1 not always very useful. Sometimes we get K1 which says various for ownership percentage. Then you have to go to partnership and ask them, I need to know what is my ownership percentage. And if they come back and say, no, we can't give it to you, you have to push back and say, we have to know. Next slide. Also, final regulation kind of addressed for 990T net operating loss, but as it relates to silos, they emphasized you have to use NOL, which was generated before the law was in effect, before 2018. You use those NOLs first, and then you use the NOLs which were generated after the law went in effect. And the NOL which we have before the law went in effect is golden. You can apply it to any activity. The NOL which you have after 2018, you have to kind of carry the silos, and there is 80% limitation rules, which later was kind of amended by coronavirus disaster regulations. So we now say, okay, there is no 80% for several years, but you still need to carry account for silos. One thing which was new too, they kind of said, okay, you have a siloed NOL, you have a siloed activity, and you disposed of that K1, you disposed of that activity. What do you do with that NOL? IRS come back and said, you have to keep it, it's suspended. If you restart that activity, then you can use it. Or if you start an activity which you classify under the same code, then you can use it. Otherwise, it's in limbo. If you never restart that activity, you don't benefit from NOL. Next slide, please. And this is addresses modifications which happened last year. Also, modification said you can now carry the NOL generated in 2018, 2019, and 2020 back to offset any unrelated business income you had in the prior 5 years. We did a couple of carrybacks. What happens, IRS, you file the amended return. IRS may come back and ask, okay, can you prove to us that it's a real NOL? So you submit the same information second time. Next slide, please. The second final regulation which we got last year was regulation on 4960 excess compensation and excess parachute payments. And IRS came out and gave us guidance for what to count, what not to count several times. Final regulation provided more guidance what you can exclude actually and what you should count. So the background of the 4960, and I know it doesn't apply to many organizations because you have to have a person who receives more than $1 million in compensation or excess parachute payments. And excess parachute payments is 3 amounts of the base compensation. And you calculate it using 5-year average compensation in prior years. IRS came and said, okay, we know you guys submitted a lot of questions and comments, what do we count? Because at one point it was, okay, you have exempt organization, you have related organizations, and the related organization defined by control, you count everything. So you might have a volunteer board members who has his own business, and it's a family foundation, family controls the foundation, family controls the family business, do we count the compensation? And everybody was a little bit nervous because it doesn't look fair, it doesn't seem fair. IRS addressed this question and said, okay, you have several exceptions. And I would recommend if you have a situation where you have questions, go to your tax professional and ask. because it's specific for the situation. Next slide. And this applies to covered employees. And once you become a covered employee, you're always a covered employee. The organization which has top 5 compensated people need to kind of keep track of these people on off chance they will get more than $1 million in compensation. Next slide. Final regulation gave us a little bit of guidance how to calculate what actually is included in compensation. Because before it was referred to another code section, and when you go into details, it wasn't really clear, what do you include? And they said, okay, treat the compensation as paid when it's vested. So that means as soon as it's vested, you have to include it in calculation. It also gave additional guidance in volunteer exceptions. There is limited hours, non-exempt funds, limited services. So how do you look at the compensation, how you started? First, you probably need to talk to your HR, maybe an attorney if you have a CEO which has some not qualified retirement or some other compensation. You have to know all the pieces. You start with W-2, which is easy. Then you look, okay, do I have any earnings on vested 457B and 457F plans? Then you look at the, do I have any vested amount deferred to next year? And it's usually bonuses. And it should be vested. So you should have the right to it by the end of the year. It's all based on a calendar year. You should have a right. If you don't have a right, it's not vested. And then you just remove previously paid remuneration, and you remove group term life insurance amounts, and you also remove 401k. Next one. So what do you need to ask? You need to ask if there is any non-qualified retirement plans, if there is any other compensation, which maybe you don't know. And it could be that you have something in place which is not vesting every year, which is ahead of vesting date. Like all the amount will be vested on that date. You need to know that. So if you have those plans, is it vested? If it's vested, are there any accrued earnings? How do you treat bonuses? When the bonus vests? Do you have any document for bonuses which says, okay, even if you leave January 5th, you vested on December 31st, you are gonna get your bonus no matter what. If it says you need to be working to get your bonus, it's probably not vested. So accounting need to coordinate with HR, sometimes with attorney, because attorney may be setting up those compensation plans. Also, you have to figure out, do you need to pull any compensation paid by related organizations? So if you have a complicated structure, like exempt organization, maybe a controlled taxable corporation, maybe another exempt organization, and compensation is coming from everywhere, you have to aggregate and look through it and figure out who pays what. Next slide, please. And excess parachute payments, it's a payment which will be contingent on involuntary separation. So if somebody leaves or retires by their own will, do not count it. So there should be some involuntary separation. And it needs to be pretty big. It needs to be three times of base amount. And what you need to do, you look at 5 years of tax years, recent tax years, and you calculate the average compensation. But it's good to remember that you're not only looking at W-2. Sometimes it could be something else. It could be acceleration of other payments. Could be some COBRA payment. So you kind of need to include everything, then calculate present value and figure out, are you over those 3 times of the base amount or not? Next slide, please. You pay tax for your excess compensation on Form 4720. You don't have to pay to make estimated payments for 4720. 4720 needs to be, the IRS is looking that it will be automatically, it needs to be mandatory e-filed. Before we could paper file it. Now they're looking at it. I don't think it's final yet, but they're working on it to be electronically filed. One thing to keep in mind, Form 4720 is open to public disclosure for private foundations. So I don't know how they're going to address excess compensation. If it's going to be the same, then you just need to keep in mind that it's going to end up on the internet. I'm going to touch just a little bit about state updates. It's mostly about charitable registrations because usually exempt organizations have more issues with charitable registrations and it's filing income tax returns. If you don't have unrelated business income, you're not subject to state income tax. But you may be subject to charitable registrations if you are soliciting in a state. And definition of solicitation is different from state to state. And it includes direct or indirect ask for contributions. If you offer to sell or your maybe, I don't know, membership, you sell something you produce, or if you run a special event in a state. And each state, each attorney general, if it's an attorney general office, which governs charitable registration, will have set of rules when you need to register. Usually, if you're in a state physically, you have to register. There is no way around it. Some states say, okay, you don't have to register if your gross receipts are less than 25,000, but they don't look at gross receipt from the state. They look at gross receipt from everywhere. It's a pretty small organization, usually doesn't apply. You need to be very small. Next slide, please. Then the question starts, okay, I'm not going to go into the state physically. What do I do when I solicit money through internet? And in 2001, there was some guidance. It's not a law, how to look at the internet fundraising. And Charson principle says, okay, you can use this one, the state can use that when they look at charitable activities on internet. Usually if the state has any constitutional jurisdiction over the exempt organization, this organization has to register. When charity doing the deceptive solicitations, then it's broader. Next slide, please. What if you're not domiciled in a state? You do everything right. It's on your website. What do you do then? Do you have any non-internet activity in the state? That may trigger the registration. Do you try to do specific solicitation for the state? Like you ask for Colorado, just do special ask for Colorado. Do you receive that from that state on ongoing repeated basis? And for example, you send a thank you letter and you say, thank you so much for donating, please donate again. Because even please donate again, state can decide that you're asking for donations, you have to be registered. Next slide, please. So depending on the state, there is different rules for solicitation materials, and we included a couple of links because if you guys go there, like Perman has really good summary by state, and other links do the same. They kind of explain to you what you need to put on your solicitation, because it could be very, very small and it could be huge, and you need to hit all the points. So if professional fundraiser solicits on your behalf, they need to tell that they are soliciting on your behalf and they are actually a professional fundraiser. If you get in trouble with the state, there are several law firms which specialize in charitable solicitation. It's a good idea to use them because they deal with that on a constant basis. And it's not just normal file your annual registration, but something more complicated. Next slide, please. Yeah, we got a really good news about Schedule B. So there was 4 states which required to provide full Schedule B to the Attorney General. And that was a point of contention, and people were fighting it for a long time. California Attorney General was pushing back and saying, no, we need that information. You have to do it. Organization was saying, we're not going to do it. It's a privacy concern. You don't need it. Finally, Supreme Court said, okay, California, you don't have to have Schedule B with addresses and names. And starting July 1st, 2021, if you go on a website, it says, okay, you don't have to submit Schedule B. We ask them, do you have to submit public disclosure? They said, we don't care. We are not asking for Schedule B. So when you file your 990 now, even if it's amended, for example, you're amending your, not 990 with the IRS, but with the Attorney General. If you're amending it with prior years, do not include Schedule B. And it doesn't apply to private foundations because Schedule B for private foundation is open to public disclosure. New York followed suit. They said, okay, we're gonna do the same. So they suspended asking for Schedule B, and they're reviewing the policies. Also, California doesn't ask for $10 anymore when you file Form 199. It was a little bit annoying because you can e-file the 199, but you have to send a check or you need to go on the website and pay $10. Not anymore. If you file in Form 3500, there is no application fee anymore. They also removed the late filing fee, but penalties remain. So if you file late, they can still send you a notice. So that maybe you filed in a 199 and paid $10 and you get them back. That's probably because of that new law. And in New York, a bill was passed by state legislature about Schedule B, saying that you don't have to send it to New York Charities Bureau or Department of State, but that bill has not been signed yet by New York governor. So once it's signed, it will be official.
Since the pandemic hit, a lot of employees have scattered around the US, and so this is becoming a bigger issue for people. So if your employees want to move to Bali or Hawaii or Texas or wherever, what does this mean for you if you're an exempt Oregon, California, for instance? But there's all sorts of considerations, and there would be another whole webinar to go over all these issues. But if you have an employee there and they're soliciting from charities, and that could open up the registration requirements Elena just went over. It may open up business tax requirements if you have unrelated business income. There could be sales tax issues, and you have to look at, are you meeting nexus? So you have some gross receipts issues that might trigger filing requirements. If you have an employee sitting in another state, you may have employment tax returns to file. And if you have a payroll service like ADP or something, that's fine. They can handle that. Just make sure that you're addressing it and you're filing in the states where you have employees. And there could be franchise tax issues in some states, and each state is different. So it does require, some analysis if you have an employee move. Next slide. So nexus is really kind of the key to whether or not that could trigger filing requirements in a lot of cases. And so if you have employees that are telecommuting from another state and they're working from their home office for you, that may be enough to create nexus to require you to look at some of these filing requirements. So in an employee sitting in a state versus just going to visit a state is different. So if it's regular and systematic and they're going there regularly, it could trigger a requirement for you. Employees working from home in another state could create nexus. And so that could mean you might have to withhold state tax for that employee if they're performing services in that state. they generally, your employee would generally be subject to tax in that state. So if they're working from, if you're a California organization and you have an employee that's working from Colorado, their payroll, if they're earning it in Colorado, would all be Oregon source, even though they're working for a California nonprofit. So make sure you're doing that payroll correctly. And some states have some exceptions to these rules. So like I said, it varies state by state. Some states have reciprocity agreements. So, before you say, yes, employee, you may work from this state, just make sure you're looking into the requirements and reaching out to your providers. So keep in mind that could create additional costs for your organization. So you have more administrative costs because now you've got an additional state tax compliance obligation. You might have additional payroll tax obligations. Is this a temporary situation, or are they moving permanently? So there's a lot of different things to look into. And if you have a human resource department, they'll have to coordinate with the payroll, but a lot of nonprofits that are smaller don't have those resources internally. So just remember to consider the costs of that before an employee relocates. Next slide. Some states have issued specific guidance on state tax withholding obligations when employees are moving temporarily. So here's a list of those states. Few states have issued guidance on tax relief, and mainly that was just because people were moving, but sometimes it was temporary. It wasn't permanent. So there is some guidance out there. Next slide. This is just a quick touch on just a reminder. So individuals who itemize their deductions are able to take advantage of their charitable contributions, but a lot of people now don't itemize because the standard deduction was increased, particularly older taxpayers that don't have a mortgage. And so for non-itemizers, there is a small deduction available. It's $300 per person in 2020. And so that's a charitable deduction that's above the line, even if they're a standard deduction filer. And for 2021, that's increased. A joint taxpayer can actually deduct up to $600 on their joint return. So that's an increase over the prior year. And for those who do itemize, the 60% AGI limitation is suspended, so they can deduct. It's up to 100%. It never comes out to quite 100%, but they can deduct quite a bit more of cash contributions this year. There's some other temporary tax considerations. We put some links here. If you want to take advantage of some of these other provisions, I encourage you to read through them. Here's some more resources for you. There are a couple proposals out there that will affect donor advice funds. So the ACE Act has a few provisions in there that'll affect donor advised funds, and it's basically putting it into two different, actually I think there's technically 3 different types of donor advised funds that would be established by that. There's some other proposals in there that would affect private foundations, so it's not actual law yet, but there's some provisions coming our way that could affect that. There's some provisions that could affect charitable giving laws that are out there in play. Here's some, just a high level, some of the proposed changes that could impact charitable giving for your donors. In the individual side, the proposal is to increase rates from 37 to 39.6 with AGIs, and it's for people over 400,000. Tax on capital gains, this is a really big one. If this passes, currently taxpayers can get cap gains rates if they hold investments over 12 months. They get cap gains rates for no matter what. If they could make $300 million this year, and their cap gains rates on long-term gains will be 23.8%. There's a provision that would make their cap gains rates taxed at 39.6. or 37. There's various versions of it. But if that happens, these high-income taxpayers are going to be looking for ways to avoid tax on, and so charitable giving, may be more incentivized by this. They may cap it at 28%. So there's a lot of different versions of provisions out there, but the 28% cap isn't in there for now. So we could see these higher income donors be more incentivized to give, particularly, long-term cap gains rate type asset. So that means, stock in companies that they've held more than 12 months are going to be a valuable tool for them. One of the other provisions is to tax transfers that are made by gift or death. So this means that when somebody passes away, they're under the current law, it's the assets go to the donor and to the recipient, and there's no tax, and they get a step up in basis. Under the provision, when that goes to the beneficiary, it's basically like a deemed sale to the estate or the person that's making that gift. And there's some exceptions to that, but this they are excluding charitable donations from this, so that donations to charity will not be subject to that tax. So that's a great thing for charities. They are also proposing to limit the deferral of gain on like-kind exchanges. So that's a tool where a lot of people that own buildings and things like that, they'll sell their property and then roll over their basis to a new property. And so this could encourage some people to donate perhaps a portion of a building that they're selling to avoid some of the gains on it, since they may not qualify for the like-kind exchange anymore. So there's some things that are being proposed that actually may benefit charities and encourage more charitable giving in the future. Next slide. And this, I'm not going to go over this, but I just wanted just a reminder that nonprofits are public, and if your organization is doing something that could have an effect on the public, just make sure that you're being mindful of how the public would look at what's happening, because there's been some cases, like there was an example of a hospital board where they allowed board members to take vaccinations before they were available to the public, and so that was a like a media issue for that organization. So just be mindful that you're out in the public realm, and be careful what you're doing. So if you want to make sure that the story doesn't come out in the media and have a negative influence on your organization.
8. So the first thing we just wanted to do was do kind of a little revisit of revenue recognition. So just a reminder that 2018-08 regarding contributions received and contributions made, it was not deferred by FASB at the start of COVID-19. And so for a resource recipient, if you're receiving these funds, it was effective for periods ending after December 15th, 2018. And if you're a resource provider, you're going to have this being effective for periods ending after December 15th, 2019. So there was 2 different time periods for which this became effective. So just as a refresher, it really stemmed out to raise the question on whether grants and contracts are part of 2014-09, which is revenue from contracts with customers. So taking a look, the first item was understanding grants and contracts, particularly those from governmental funding, for whether or not the contract had a reciprocal versus non-reciprocal. So a lot of nonprofits treated any grants or contracts that were with government entities as an exchange transaction, regardless of what services you were providing or how those services were working. And the way that was thought of is the work that you're doing for the general public was equal to doing work back for the government. And so the thought was the government doesn't provide nonprofits with a contribution, you're doing a grant or a contract for the government, so the government's getting is receiving something back. The second question that came up from the new guidance was really understanding conditional versus unconditional. So trying to distinguish, when do you have a condition or when is it an unconditional contribution? So what are the different stipulations? Can something be conditional and restricted, unconditional, or restricted? And really trying to look at what those conditions and removing the likelihood that something would not happen being remote, and that's no longer a triggering item. So the first thing that came out was really understanding this decision tree. So how is it that the transaction is done? Is there some type of a commiserated value between both parties? If there is, then you have an exchange transaction and you're going to need to follow the topic 606. That was the topic on the revenue that did get deferred to an additional year. If you don't have the commiserated value, then you need to go through and put in the guidance of the new contributions made and contributions received. And this is the second part of that decision tree of understanding whether or not there's any donor imposed conditions on that as well, and understanding what is a barrier. So really when you're going through, this is a nice little chart that kind of summarizes how do you think of something if it's an exchange transaction or if it's a contribution. So things that fall under more of an exchange transaction is you have the intent by both parties to have that goods or resource or service that's transferring. And the amount, there's something that you agree upon for that amount that's being transferred. There's a contractual provision. So if you don't perform the duties, you are going to have some type of a penalty for a failure to perform. And the other item is in an exchange transaction, the person who's providing you with those funds, they're the ones that are going to receive that direct benefit. And then there's also going to be some type of a proprietary rights, such as a patent or copyright or some type of advanced information for knowledge. On the other side, something's going to fall under more of a contribution if there's no intent of receiving something in exchange for a good or service. If you're receiving the funds, you have the full discretion to use those funds however you need to be using those. There may be penalties assessed for failure to comply with a term and agreement, but it's going to be limited to funds that haven't been provided or haven't been spent yet. And the other key thing is the benefiting the public in large. So when we think about an organization that receives funding from the government, it's usually the public at large that's going to receive some type of a benefit. So if you're receiving funds to help provide meals to those that are homeless, it's the public that's receiving the benefit, not the government that's receiving that direct benefit. Great. So we talked a little bit about the guidance and clarifying what are a barrier. So really, some of the items to think about in regards to what's considered a barrier would be some type of a measurable performance. So a specific level of service, some specific output, or specific outcome, or a match. That would be a barrier. I'm going to give you $1 million, but you need to raise $1 million. So you can't recognize that $1 million until you've matched that first $1 million that you've raised. Another barrier is some type of a stipulation on how the recipient or the organization can do the activity. So a lot of the funding would be related to you have to have these qualifying expenses. You need to first have these expenses to get reimbursed or have some type of specific protocol. So that's a stipulation that's going to make that grant or contract look as having a barrier and being conditional. And then how does that stipulation relate to the purpose? So the other big item is when you have a grant or agreement that includes something that's got a financial report or some type of a very administrative or a trivial item, those are items that you wouldn't think of as being barriers. Those are just items that you're going to normally be performing. For example, if the grant says you need to have an annual audit, but you're already doing that annual audit, that's going to be more of an administrative item that wouldn't be considered a barrier. So a little bit more into what do the measurable performance related barriers mean? It's often going to be included with some type of a time limitation. So you have so long to do the work that's noted in the grant or agreement. Some type of a level of service, such as you need to provide 200 meals to the homeless, a specific number of output, or a specific outcome. So students have to achieve a specific standardized test score. That would be a barrier that's related to measurable performance. Some other things that fall under the barriers for limit on discretion is a limited use of the contribution to a specific activity, such as the qualifying expenses. You need to hire specific individuals. We're going to give you this fund, but we expect you to go and hire 3 more people to work into this program. Or you have a specific protocol that has to be met. Again, just as a clarification, a barrier is just to, once you have the grant or the agreement with the government, the next item that you have to go through and determine is whether or not you have a conditional or an unconditional grant. So the barriers are what helps us determine that those grants or that agreement has some type of a condition in how you can recognize that revenue. So the stipulations that may be related to the purpose for that type of a barrier, it would be such as requiring a homeless shelter to have specific number of meals that are being served, or an animal shelter to have to expand their facilities so that they can service so many new animals. A research report that's going to summarize the findings. And then, as I mentioned, some of the examples of the administrative or the trivial stipulations, these are the items that would not create a barrier. So if you have to do an annual report, that would not be considered a barrier on the grant or contract. If you have to do a report that just summarizes your performance, or a report that shows the number of meals provided. Just for a clarification, the report in and of itself to show the number of meals provided, that's not the barrier that makes the grant conditional. It's the, you need to service and provide 200 meals. That's the barrier because you have a specific outcome or a service that needs to be performed. So when you're going through, and I mentioned with when Daniel and I were talking, this didn't really change how your revenue was being reported. So if you had a grant and a contract, you went through, you determined, well, is this really a contribution or is it an exchange transaction? If something was considered the contribution, you then needed to go through and look, is this a conditional contribution for which I have barriers, so I can't recognize the contribution until those conditions have been met? Or is it an unconditional contribution for which I can recognize it as soon as I've been alerted to having this grant or agreement received? But what it did change is it's changed a lot of our disclosures. So if you're an organization that you're receiving these grants and agreements, there was some disclosures that already existed related to conditional contributions. So for conditional contributions or promises to give, you need to include the total amount of that promise and a description for how those amounts need to be met. So for example, if you have a lot of government grants, one of the items that we're seeing is incorporating all of those government grants that they are conditional based on a qualifying expense. You need to have those qualifying expenses for how you're spending those government funds in order to meet that condition to be able to classify that as a contribution and into revenue. So your footnote example would include, we have, for example, $5 million of conditional grants related to having qualified expenses for reimbursement before we can recognize those revenues. If you're a resource provider and you're providing these grants and contracts and agreements to an organization, there is no additional disclosures that needed to be added to the guidance. It just really highlighted that you should include in your financial statements some type of information about the unconditional promises to give. So if you've provided funds without any conditions, you should be noting those in those financial statements as well. Not intended to be just a list of all the types of conditions that need to be met in order for you to receive those contributions, but really just summarize. So think of what are the key attributes to those barriers, and you can group them together. So you may have a bunch of conditional grants that are subject to matching, other ones that have qualifying expenses, and other ones that are a measurable performance or barrier. So just wanted to highlight some of the upcoming standards The FASB has been working hard on multiple types of new standards. They did have some items that they removed from the list, such as the simplification for balance sheet classifications. And the other one that affects nonprofits is they removed from the agenda a requirement to consolidate any nonprofits that have a for-profit sponsor. So that got removed from the agenda, but they are looking at various recognition and measurements, specifically the identified intangible assets. We're continuing to get more information and new changes on lease guidance. Feel like we've been talking about the new lease updates for quite a few years, and it continues to get updated and changed as people start to do the implementation. And then some other presentation disclosure projects that FASB is working on. And we did include a link here to be able to see the whole agenda for where FASB is working and what they're thinking about, as well as some of their exposure items. The first one that's of the most importance, really, that has already been issued is the presentation disclosures for not-for-profit entities that receive contributed non-financial assets. So it's going to be for annual periods after June 15th, 2021, and you are allowed to early adopt it. And the purpose of this standard was really to increase the transparency, really highlight in the financial statements when someone receives these non-financial assets from their organization, so it shows up in our presentation disclosures. And it's for contributions of any non-financial assets. So if you receive fixed assets, the use of fixed assets, or materials, as well as any intangible services. So many nonprofits were including any gifts in kind that were received, and the value can be impacting lots of key metrics for a nonprofit, such as your program expense ratio and your liquidity and reserves if you've received a large amount of gifts in kind. And it can also have significant implications on the overall financial performance. For example, if your gifts in kind decrease, are you going to have to turn around and use funds to spend more money on those resources to make up the difference? Or are you going to have to cut back on your programs because you're not receiving as much as an in-kind donation? And so the new guidance is going to require that you present contributed non-financial assets as a separate line item on your statement of activities. So some organizations were incorporating it in with their normal contributions. So you are going to be required to have it as its own line item on your statement of activities. And then you're also going to have to disclose it by category for non-financial assets. So you're going to have to disclose the information about how the assets are used, including any donor or grant requirements, and then how they're valued when you receive them. And then the last item on the presentation is you're also going to have a separate line item for your non-financial assets in the statement of activities. So like I said, it can't be included with part of your contributions. And then you'll have to, if you present this comparatively, you're going to need to make sure that you have this information for both years. So we included an example. So the first example in the statement of activities you can see right here is the in-kind is its own line item. It is incorporated underneath contributions from individuals, but we have it pulled out of cash and other financial assets as an in-kind line. And then the second option is you could show your in-kind, both your revenues and your expenses, in its own column under the without donor restrictions for your statement of activities. So those are just two different examples that were in the guidance for how you can show the gifts in kind going forward. Again, so the disclosure requirement is both quantitative and qualitative. So you need to be showing it as what's received by category, and then how you're using the funds, and then how the nonprofit's policy is. Any descriptions, you'll also need to include the valuation techniques, and then what's the principal market? So how did you come up with that fair value measurement? I do want to let you know that as part of this slide deck, when it's sent out, we do have a link to one of our resources. Earlier this year, we did a quite in-depth presentation on the gifts in kind, which includes both the auditing information, how to come up with the valuation, as well as some tax implications. So there's a lot more information on this new standard in that presentation that's available. The next item that I wanted to highlight were just some of the current issues that the FASB has been thinking about as nonprofits are dealing with the financial reporting for COVID-19. So FASB has created its own page just for the response to COVID-19, which includes some of the deferrals of ASUs, some more education items, and board meetings. The first item is the lease concessions. The FASB did do some changes to the staff interpretation on the COVID-19 in leases. So you can account for the concessions for rights and obligations. And so there is some adjustments that you can make for the lease concessions going forward. So the next item here that FASB came out with has a goodwill. It was issued in March 30th of 2021. It's for both private companies and nonprofits. The key items that came up from this new standard is you can elect to perform any goodwill impairment. There was when a triggering event occurred, but the guidance is now saying you can evaluate it at the end of each reporting period. So whether or not that's going to be your fiscal year end or an interim basis. And it was effective for fiscal years beginning after December 15th, 2019. So even though this guidance came out in March of 2021, it actually was able to be for any organizations that were still doing their December 31st, 2020 financial statements. So instead of having to go back and test your goodwill for impairment at a triggering event when the COVID-19 pandemic was deemed a pandemic, you could instead look at it at a reporting period or an annual period. Early adoption was permitted, and it was also for a prospective application going forward. Some of the other items that FASB was looking at, the Paycheck Protection Program, higher education, and healthcare. So Tammy touched on the PPP loans. There were two ways that you can be reporting your PPP loans. The first is as a debt. So you would have it as a loan payable, and then you would release it on your gain on extinguishment upon the forgiveness. And the second option was if you deemed it a conditional grant. Again, it was deemed a conditional grant, so you would have your conditions, and your conditions would mean that you would have this as a refundable advance on your statement of financial position. You would not show any accrued interest. You can recognize it as revenue once those conditions have been substantially met, and then you would be showing it as your grant revenue or a gain. Those were really the two options for nonprofits to be following. So the other items that came up was, just to remember that there are some very important disclosures. So you need to be able to include in your disclosure the accounting principles that are being followed, as well as the revenue and the assets allocation to the current and future periods. COVID-19 had quite a big impact on nonprofits in general. And it's not just one or two areas that got impacted, but quite a few. The first item that we were really seeing was subsequent events. I know I had audits that we were issuing, April, May of 2020, and we had quite some big subsequent events regarding operations being shut down, PPP programs, those loans, understanding what did that mean, and then when operations were able to start back up with limited capacities. And so our subsequent event footnotes got pretty long as things constantly were changing until the financial statements were being issued. Now what we're seeing is a lot more in kind of risks and uncertainties. We just don't know what the impact is going to be or continue to be for COVID-19. We mentioned there could be some asset impairment. So if you shut down your operations, are you still able to use your leasehold improvements or any other physical locations for where you are? Fair value measurements, lots of things regarding revenue recognition. in relation to, do you have an exchange transaction or a contribution, and what are those conditions? Some modifications for liabilities, and then the other item was some insurance recoveries. We also had contingent losses. We are seeing a lot more going concern evaluations. It doesn't mean that we're seeing more going concerns added in the nonprofit, but a lot more questions and making sure that management has gone through and considered going concerns going forward. We're also seeing business combinations. And then just internally for nonprofits, a lot of internal controls and segregation of duties. As people have moved to remote, how are you still making sure that who's opening the mail and who's depositing checks is being separated? And then if we think about our fraud triangle, just making sure that we remember that there is an increased threat for both health or financial positions for employees. So increase for potential of fraud. Going to give a quick overview of the lease standard. Really, one of the things to be thinking about is that you're going to be having going forward a right to use asset as well as your lease payment. So we had both finance and operating lease. So if you have a finance lease, you have a right to use asset and a lease liability. And then on your income statement, you're going to have the amortization expense and interest expense. And then for cash flows, you'll have cash paid for principal and interest payments. Underneath operating, you'll have a right to use asset and lease liability. You'll have a single lease expense and then cash paid for your lease payments. So there is an exemption that if you only have a 12-month or what's considered a short-term lease, you would not need to go through and do the new lease standards. Kind of the high-level takeaways is the reason for this was different users were finding information about leases differently. There's some mixed feedback from FASB in regards to how this is going to compare to interest and amortization. And really the main item is it's going to be a challenge during implementation. There's going to be ongoing applications. And FASB is continuing to look at ways that they can continue to provide some education as well as areas for improvement. There's also items out there regarding the discount rate. So it's to reconsider the risk-free discount rate for leases that are for non-public business entities. So including all nonprofits and employee benefit plans. Again, this is still a tentative board decision. They've talked about the level of accounting policies, how the discount rate is working for the accounting policy and interactions. Hopefully it would be effective for fiscal years ending after December 15th, 2021, but has not yet been adopted yet. So we're still waiting to hear from FASB on how this discount rate for leases will be applied. Some additional kind of guidance that's coming down in the pipeline. There is some current expected credit loss. So, contributions receivable or pledges are not going to be part of this. So most grants receivable, again, they're going to follow a contribution model. So this is really for loans and debt and any trade receivables. So really looking at what these credit losses may be. The other big item is coming in the pipeline is reference rate reform. So the reference rate is a variable interest rate that you use to determine your interest-related cash flows. The biggest item that we usually see is going to be the LIBOR rate that banks offer for global financial systems. So what does this reference rate reform mean? It means that the LIBOR, in easier terms, that the LIBOR rates are going away. So they've called for the identification of a risk-free alternative that's going to replace these interbank offered rates and transition plans. So really tying benchmark rates more closely to items that can be observable in arm's length transactions. So there's quite a few. The topic 848 is providing accounting relief, as well as there was some diversity in practice. So by accounting relief, we mean that it's going to help simplify some of the accounting evaluations, and this relief is temporary, but there is ongoing monitoring. LIBOR is not going to stop publishing its rates until June 30th of 2023, so there's a little bit of time before those rates stop. But the current relief, and FASB is talking about possible extensions, means that the relief is going to expire December 31st, 2022. So there is a time difference between when the relief expires versus when LIBOR is going to stop publishing those rates. There is another goodwill and intangible project that FASB is working on that will impact nonprofits. And really what it does is it's going to extend the private company alternative to all nonprofits. That would allow you to amortize goodwill over 10 years. It would include certain customer-related intangibles and non-compete. And then you would only need to test goodwill impairment upon a triggering event instead of annually. So if there's no triggering event, it doesn't need to be tested. The last section is just wanted to provide an update on some of the single audit and uniform guidance. Like I said, the nonprofits across the board have had quite a big impact on both accounting and auditing challenges. There was a lot of federal funding that came out from a lot of different entities before any guidance came out. Therefore, there was increased fraud risk, a lot of internal control considerations, lots of questions for laws and regulations. Again, uncertainties with going concerns, questions on accounting estimates, and the guidance continues to be postponed. I'm happy to say that the compliance supplement for this year was released just over a week ago, but it is broken out into 2 parts again. So historically, federal funding was provided for the pandemic. There was a lot of new programs, but it also impacted some existing programs. So there could be quite a few organizations that this is the first time receiving federal funding and needing to have a first-time single audit. Continuing to have a lack of federal guidance for what to do with this funding. And there's a lot more major programs, as some of the specific funding that came out in 2020 and 2021 is going to require additional major program testing. Like I said, it's been a crazy year in relationship to the federal funding, starting with the public health emergency all the way to we're still getting laws issued that's providing the additional federal funding sources. There was a memo that was released to those who receive those federal agencies who offer federal funding that really automatically provided a 6-month extension again in March for up to June 30th, 2021 year ends to have a 6-month extension for when their audits are due. This does not impact when your taxes need to be completed, but when you need to have your single audit completed for federal purposes. So for example, if you're a June 30th year end, your normal due date for your federal audit compliance is March 31st, 2022, but that has now been automatically extended to September 30th. As I mentioned, there is the new compliance supplement. It is provided here. And the other website that we've been told to continue to watch is the CFO.gov, as that's going to be highlighting what type of funds the government has determined have new ARP programs, and those new ARP programs are going to be deemed higher risk and a major program for testing. And the guidance for those new programs hopefully will come out at some later date. And so the guidance of those programs has not yet been released. As I mentioned, the supplements it was issued in 2 parts. So the first part was released on August 13th, and it's effective for all audits after June 30th, 2020. And then the second part will be for certain new ARP programs that will be posted to the CFO.gov. Unknown timing for when that's going to come out. So what does COVID-19 funding mean? Well, in the first year, it really just meant funding that came from the CARES Act. But then now we're in year 2, and COVID-19 funding is all new programs and all existing programs that are subject to single audit. So it just lists out the 5 different acts that are all falling under year 2 COVID-19 funding. Just a reminder that if you do have COVID-19 funding, both on your CFA and your data collection form, you need to be highlighting in the title that it is from a COVID-19 source, so that is separated out from your other funding source, even if it is the same CFDA number. There's lots of challenges on completing the schedule of expenditures of federal awards, such as when do you have an award And how do you know what type of programs is being funded? There's also a period of performance, as some of these new awards allowed for lost revenue that would be in a period prior to your fiscal year end. And so the AICPA has released some information and guidance for the accrual basis on how to complete your CFA.